And then we're going to negotiate for you. We're going to help you navigate through all the paperwork. A typical purchase agreement right now is probably about, I'd say, 30 pages. A lot of legal documents to go through, and you really should have somebody representing your best interest. On how to find an agent, recommendations from friends. Go to a real estate office in your neighborhood and go talk to some people. Go to some open houses. How does the agent handle themselves in an open house? This is a great way to find an agent, because that is the real person that you're going to see, and then you can kind of see how they're going to handle themselves. Are they professional? Ask them a few questions and ask them to get back to you. How long does it take them to return, your question? Does it take a week? Or do they call you the next day? It's a great little test to see, is this a great agent for me? And more importantly than anything, I think, make sure that you guys click. You're going to spend a lot of time with this person, especially if you're a buyer. You're probably going to spend quite a bit of time with this person, so just make sure that you guys click. And then, do they offer a performance guarantee? You should be able to get out of any contract with a realtor at any time by you just saying, you know what, it's just not working out. I think the most important thing before you start to look is really getting an idea of how much you want to spend. I mean, there's a difference between what you can qualify for and what you're comfortable with. And make sure that you're comfortable with that amount before you start looking. Dual agency is something I want to talk about too, and your agent should bring this up to you early in the process. I think dual agency is fine. The only time that I worry about it is that when the same agent is being the dual agent. So let's say you see a house you like and you call the listing agent that's hanging on the sign, and then you do a purchase agreement with that person. I don't think that's a good idea. And the reasons are that agent already has a relationship with that lister. So that person who's selling the house, they've already had, and they probably knew each other beforehand. So they have a long history together. That agent, whether they think it or not, probably has a little more loyalty to that person than they're going to have to you. So what I suggest is never call the listing agent. And my reference for you guys is it's like calling your husband's attorney for divorce advice. They're not going to have your best interest in mind. You really want to make sure that you have your own agent. They're going to bargain for you. They're going to have your best interest in mind. Sellers will not accept a purchase agreement without a pre-approval. So that's something that you're going to need. You're also going to need earnest money. And I'm always surprised at the number of people that you go looking and they want to make an offer and they don't know that you have to have some money. You need some earnest money. Earnest money is that money that if you back out of the transaction, the seller gets to keep the money. If you're financially capable, you can't get it back. But if something changed, like you lost your job, you can get that money back before closing, usually. Contingent versus non-contingent offers. You hear a lot about that these days. It's really better to be non-contingent. So if you're thinking you want to buy a new house, I really suggest, especially in the market that we're in right now, is that you put your current house on the market and get that sold first. We're seeing a lot of people right now that did it reverse, where they went and bought another house, and now they've got two homes. And, it's not a very fun position to be in. Pre-approval is a letter from your lender. So it's something you'll talk to your mortgage provider about that. And they will, we like to see it address specific as well. So, if you find a home, what your agent will do is your agent will call your lender and say, hey, we found a house, we want to put an offer in on it. And then your lender will send me a letter saying that you are financially capable to make this work. Let's see, if you do make an offer, it's accepted, what kinds of things would you expect after that? We really suggest that you do a home inspection. Your agent will be able to recommend someone for that. Get ready for closing. Homeowners insurance. You need to get homeowners insurance for closing. For divorcing people, you've got to have a certified copy of your divorce decree at closing. Very, very important, and it's got to be a copy that's got the raised seal, cannot have any evidence of tampering. When we look, we look at things, similar things that have sold in the neighborhood, and we're just trying to give you a realistic idea of what's really possible. And we've walked away from a lot of listings, and be careful because there's many agents out there that will tell you whatever you want to hear. They'll agree to your price, and you know what they're going to do? They're going to be back at you 2 weeks later for a price reduction, and then another 2 weeks later for another price reduction. They're just, we call that buying the listing. So, I mean, we just kind of make it a point not to do that. It's just not part of our, philosophy, I guess, but there are people that do it. The main thing about real estate is disclose, disclose, disclose. You need to disclose anything that's happened to the property, any work that's been done, any issues that have come up while you've owned the property. Even if you do an as-is addendum and it's later discovered that, oh, the basement floods every spring and you never disclose that on your disclosure, you're still in trouble. So you just need to make sure that you disclose everything, and even if you think it might damage the saleability of your home, you'll be much more damaged if they come back after you. And so just be upfront, be honest. People respect that, and if they know it up front, it's much less of an issue rather than the other way around.
The whole process of a mortgage is pretty intimidating. Even calling someone to check your credit, it's sometimes worse than stepping on the scale. When you are looking at doing a mortgage, you want to make sure, again, that you go through the pre-qualification process and the pre-approval process right away. You don't want to wait until your house is already sold and you don't know where you're going to move, because things can happen pretty fast and it's a pretty stressful time. So you want to have everything in order. I always recommend that when people are going through divorce, they check their credit. I think somebody in here mentioned a little bit ago about surprises. You don't want those surprises. You want to know what your joint credit is and your situation is, and you also typically want to close a lot of those joint accounts, because the other person, as trustworthy as they may have been, may feel that they can go and charge more debt. Maybe they're struggling at the time and you're counting on your debt staying in place. So it's really important to pull the credit report. It's important to see what the whole picture is. When you're meeting with a mortgage person, some of the documentation that you should keep on hand is a copy of your divorce decrees. And Andy already mentioned about the title companies needing a certified copy. Don't take the staples out. It's something about recording. They don't want the staples removed and restapled, that certified copy. So many of my clients have to run down to the courthouse. They never received a certified signed copy. You get a preliminary and you think that's it, but underwriters, title companies, they need a signed copy and a certified copy at the title company. If you're receiving maintenance, spousal maintenance, child support, make copies of those checks, because when you're going through the mortgage process, you may have received it on time at all times, but if they send you a check or they deposit it into your account, you want to have at least 3 months of copies of that, 3 consecutive months, to prove that it's on time and it's income, because a lot of times people are going out there and qualifying for mortgages with their current income and spousal maintenance or child support added to it, and you need to have that tracking of those consecutive 3 months. And keep updated court documents showing increases and decreases in child support, any changes. That would be a good situation where you would want to ask for another 10 copies, because you're going to need that to go with your certified decree. So be sure to keep those documents on hand, keep them in a safe place where you always know they are, because they're important to have. Obviously, we've brought up quite a few reasons why. The most common one, of course, is a 30-year fixed rate, but there are a lot of different options. And let's give an example. Let's say that you need a house that's in a certain school district for the next 5 years, because that's how your decree is written, or that's how you guys agreed, but it's really expensive in that district. There are different types of mortgages that you can get to get you through that time. You always want to be careful not to have a prepayment penalty or mortgages that accelerate in principal, like those cost of funds index. Be very, very careful not to get those type of loans, especially in a market where the rates have been going up. But let's say that you're only going to be in for 1 to 3 years, and then your child graduates and you plan to move to a townhome or out of state, a 3-1 ARM is probably a really safe product for you, because you'll have 3 years at a little bit lower interest rate, and after that you don't have to sell the house. You could remain on the ARM or refinance, but it'll give you those lower payments. One of the products that I like to offer people in a situation where they're going through a divorce is, let's say that their kids are young and they need 10 years of lower payments, and then they're going to be able and work full-time in the next 5 to 10 years. There's an interest-only product that is pretty good. I caution you against doing a loan like that when you're doing a zero down type of thing. If you don't have any equity to put towards your next house, I really caution you on that. But if you have 15, 20% down or more, you have a great deal of equity. That interest-only product can save you a few $100s a month, could save you $200. Just know that after that time period where it is interest-only, it will go to a higher rate or a higher payment. If you have credit issues, and it's not perfect credit, which happens quite a bit in a divorce, that doesn't mean that you can't get a mortgage. If you have lates, if you can't make a payment, always remember that mortgage payment is going to affect your credit the most, okay? The second thing is any installment loans. That will affect your credit the next. Now, I think I've mentioned this before in other seminars. When you're looking at your mortgage and you're not able to pay it, the problem with that is if you do sell it, those late mortgage payments are going to stay on your credit for a very long time. It doesn't mean, though, if you do have lates, that you can't get a mortgage. There are other mortgage options out there. There's A- credit, which is a little bit higher in interest rate, maybe 1/4 to 0.5% in rate. There's B credit, which can be different products. There's C credit. Just know that buying a house is still really, really important and a good way to build your equity and build your assets. And don't be overly concerned that if the credit hasn't gone perfect, that you can't get a house. There's always questions about how do I take my spouse out of the house. We know about the quitclaim deeds already, but how do we pay them? It depends on how your decree is written. Are you paying them in 3 years, 5 years, or do you have to pay them right away? There's different ways to do that. Of course, you can always refinance the home mortgage if you qualify for it. You can always do a home equity line of credit or a second mortgage, which is a cheaper way to go in and get the money because you don't have huge closing costs like on a refinance. And that's a pretty common way, either paying interest only on a line of credit or doing a second mortgage for a fixed amount of years.